Hey everybody, this is David Skarica. Hope you're all doing well. Sorry, I got backtracked. I'm finalizing a new consulting deal, marketing agreement with Regency. So I was kind of doing that all day and talking to some people about that and kind of doing, there's off internet stuff, not the whole business is still done off internet, over the phone, that sort of thing still. So which is good because I don't think your whole life should be on the internet. But anyhow, um so we're gonna get into today. So this is gonna be out early Thursday morning. I had a long day, so I went to bed early, and then I kind of got up, couldn't get back to sleep. So I'm like, you know what? Let me make up for not having a stock chart of the day on Wednesday. Do it Thursday morning. So we're gonna have two today. I'll put out another one after the bell. If I had put out a stock chart of the day Monday, I probably wouldn't cared as much. But because now it's Wednesday. So sorry, it's Thursday. I've only put out one this week. I really want to get this out. So today we're going to look at emerging markets. It's going to be a short update, but I just wanted to show you how. And this is one thing I do love about Twitter, or X or whatever it's called now, is that basically you find like this bar chart is a great Twitter account, an excellent service. So you do find these interesting stats, et cetera, et cetera. I use it kind of as a news feed. Everyone knows I'm a big Raiders fan too. So, I read a lot of Raiders articles on there. I look at stuff like this. You'll find these great charts on here. So basically, one of my themes starting 20 plus years ago with emerging markets would outperform the, emerged world, or I guess, developed world, as you could call it. And you can see it did from, about when I published my first book and started my newsletter till 2011, but now it's it's really underperformed. So it's about the same performance over that 20 plus years. But I think we're now going to enter another period like this. And why this happened was very simple. Back here, a lot of emerging markets are based on commodities. This was the big commodity move. So places like Brazil, a lot of the markets in Latin America, Russia, when it was still part of kind of the global markets, did very well during that time period. And then of course we've had this financial engineering with rates at zero, QE, targeting asset prices. And that's really occurred mostly in the developed world. Places like India, Brazil have had real interest rates, and they haven't had the need to buy their own debt, et cetera, et cetera. And, so they've really underperformed since then. But now I think with interest rates coming back up, with probably, another prolonged period of stagflation, we're again going to see the emerging world do better. Like, for example, in 1970s, Japan was still an emerging market. And while the US stock market and many developed stock markets went in that huge trading range, we saw Japan become the best performing market in the world. Actually, one of the simple trades that Soros put on that made him all that money in the 70s was he was long commodities with Jim Rogers, and he was long Japanese equities, and they were short US equities at different time frames when those bear markets went on, like 73, 74, 77, et cetera, et cetera. But I think now we're kind of bottoming, and you can see this is the EEM, and you can see that the EEM, so this is basically this is also just emerging markets into US dollar terms. The EEM, you can see, is at basically the same level it was at the top back in 2007, which of course adjusted for inflation is even lower. So it hasn't done much. And you can see, I think one of the signs here, let's look for a short-term overperformance. Like if you look at the EEM, you can see in 2002 and 2003, the EM did not make new lows, where the S&P, we'll get the S&P here just to show you. S&P in 2002, sorry. I don't know what's wrong with me. It's because I'm far away from my keyboard because I have my mic. I know this new mic, so I sound better. So you can see the S&P here in 2002 did make a new low. So there was a real outperformance in the emerging markets. And then once the bull market started, they really outperformed there. And then they did very well again in the first move out of the financial crisis. But of course they've lagged. But the emerging markets, again, they don't have these real estate bubbles. They don't have these debt bubbles. China does somewhat, but a lot of the rest of them don't. They're not bent on cheap money. Like I said, you go look at interest rates in Brazil and India, they were like 8 to 10% this whole period of zero interest rates in North America. So, you can see that. So like we'll look at, for example, like one of the funds I like pays a huge dividend is the IFN. So you can see again, this is done pretty well. But again, when you take what the S&P has done, like, its peak was about $10 for the financial crisis. It's 70% above that. Of course, the S&P right now is nearly triple. It's nearly 4,500, and its pre-financial crisis top was like 1,500. So you can see again, this is underperformed. Now with the dividends, it's not underperformed. So that's another advantage. You get emerging markets. It's all kind of. I'll do a paid Patreon / lifetime member stock chart of the day, showing you some of these great emerging market stocks you can buy that yield 15-20%. So it's going to show you, this is Brazil, and again, you can see Brazil is still below its 2008 lows. And if we do get some kind of new secular move in oil and gas and commodities, Brazil, even with a socialist government at the moment, is still a natural resource-based economy. And and I always told people, I had people who really were pro, the Bolsonaro, the kind of right-wing pro-business Brazil, a president. And I think the EWZ was about 35 when he got elected. And I was like, look, the problem is this: Brazil's bent on commodities. Until you get another secular move in commodities, it doesn't really matter what this president's going to do business-wise. And it didn't matter. You can see that Brazil is still 13 or 14% below where it was back then, So, but I think like now is the time, like it's always difficult to time these things, but you can see with the emerging markets that cheap. I think now when the Federal Reserve cuts interest rates and does get a little easier policy, I think these are going to be the place to be, like the 2000s, or at the very least, again, you can get this rally like 08, 09. You can see that the emerging markets, like, really outperform the S&P. Like they all went back almost to their highs in 2011. Then they underperformed for a while. And again, I think it was because this QE, this zero rates, creating these asset bubbles in all the Western economies, which benefited the zero rates, and the emerging markets didn't have. Well, if you think I'm right and those zero rates are never coming back, well, then again, that helps the emerging markets, because that means you're going to have real organic growth in the West, not just zero rate asset bubbles. And this is where all the growth is. India, Indonesia, Thailand. This is where all the growth is in the global economy. It's not in the developed world. The developed world is stalling out in growth. We're all kind of there's that old song that was popular. We're all Japanese now. Well, we kind of all are Japanese in terms of economic growth. That Japan basically peaked out in the early 90s, has had almost no growth since, and has underperformed a great deal. So anyhow, today I wanted to show you emerging markets. In the future we'll have, in our members versions, we'll have maybe specific stocks we like in emerging markets. I'll show you again some of these huge dividend pairs. Longer term, I really like Argentina because it looks like they're going to have a pro-business president for the first time in decades, right? So I thought I'd leave it there, and I hope you enjoyed this. And again, you want to buy stuff when assets are cheap. And this is like, again, why I went to a members version, more educational service, because writing a newsletter where people want stock picks every month, something like this, which is really long-term based, like you're going to have a 5-10 year time frame, it doesn't work with a monthly newsletter. It just doesn't, because people want to make money over a 2-3 month period, and that's not always realistic. So anyhow, I'm going to leave it at that, and hope everybody is great. Yeah, I apologize for not putting that out Wednesday, but it's coming up very early Thursday morning, and you're going to get 2 stock charts of the day here on Thursday.